First and foremost, volatility is a fact of life in crypto. Double-digit percentage swings, both upward and downward, are woven into the fabric of this market. Attempting to chase every rally or panic selling at every dip is rarely a recipe for success. As the history of Bitcoin shows, the asset has endured multiple drawdowns of 50% or more, only to recover and reach new all-time highs. The crypto winter of 2018, when Bitcoin fell from nearly $20,000 to just over $3,000, serves as a powerful reminder that patience and conviction are often rewarded in the long run. Second, it pays to understand the unique drivers behind each cryptocurrency. Ethereum's validator exodus is a technical event, reflecting changes in staking incentives and network upgrades. XRP's decline is tied to specific large transactions and regulatory uncertainty, particularly around the status of crypto ETFs in the United States. Dogecoin, for its part, remains subject to the whims of retail sentiment and online trends. Being informed about these dynamics can help you make more rational decisions rather than simply following the crowd. Third, keep an eye on the broader macroeconomic and regulatory landscape. Changes in central bank policy, geopolitical tensions, and regulatory actions can all have outsized impacts on the crypto market. For example, the recent delays in U.S. ETF approvals have dampened institutional enthusiasm, while rising interest rates have made riskier assets less attractive. Conversely, any positive regulatory developments or signs of easing global tensions could quickly reignite risk appetite. And here's a little-known truth. Some of the most explosive rallies in crypto history have occurred immediately after periods of maximum fear and pessimism. In 2017, for example, many declared Bitcoin dead when it crashed below $3,000. Within a year, it had soared past $20,000, confounding the skeptics. The lesson here is that extreme fear can create the very conditions for the next major bull run. Looking ahead, what practical steps can investors consider? First, reassess your risk tolerance and portfolio allocation. In a market as unpredictable as crypto, it's wise to avoid overexposure to any single asset or sector. Diversification across Bitcoin, Ethereum, select altcoins, and even traditional assets can help cushion the impact of sudden swings. Second, resist the urge to make impulsive decisions based on headlines or short-term price action. Instead, focus on long-term trends, fundamental adoption metrics, and technological progress. For those interested in active trading, periods of high volatility can offer unique opportunities. However, it is crucial to set clear stop losses, manage leverage carefully, and remain disciplined in your approach. Remember, many of the recent liquidations occurred because traders were over-leveraged and unprepared for sharp moves. For longer-term investors, now may be an opportune time to revisit core convictions. Has anything fundamentally changed about Bitcoin's role as a store of value? Is Ethereum's transition to proof-of-stake progressing as planned? Are leading altcoins still delivering on their roadmaps? By regularly reevaluating your investment thesis, you can navigate the noise and stay focused on what truly matters. Another dimension worth considering is the impact of ongoing technological innovation. The crypto industry is notorious for its rapid pace of change. In just a few years, we have seen the rise of decentralized finance, non-fungible tokens, and now the increasing integration of artificial intelligence with blockchain technology. These innovations have the potential to unlock new sources of value and drive the next wave of adoption. For example, the growth of decentralized autonomous organizations, DAOs, is enabling new forms of community governance, while Layer 2 scaling solutions are making transactions faster and cheaper than ever before. At the same time, regulatory clarity remains a double-edged sword. While clear rules can attract institutional capital and foster innovation, overly restrictive policies risk stifling growth and pushing activity offshore. The ongoing debates in the United States Congress and among global regulators will have far-reaching implications for the future of crypto. Savvy investors are closely monitoring these developments as the regulatory environment can shift sentiment and capital flows in dramatic ways. Let's take a moment to explore some historical parallels. The dot-com bubble of the late 1990s, for instance, saw a frenzy of speculation in internet stocks, followed by a brutal crash. Yet, from the wreckage emerged some of the world's most valuable companies: Amazon, Google, and others. Similarly, each crypto bear market has cleared out speculative excess and paved the way for new cycles of innovation. The survivors, those projects with genuine utility, strong communities, and sound fundamentals, have consistently emerged stronger. Returning to the present, there are signs that institutional interest in crypto remains robust, even in the face of recent volatility. Major banks and asset managers continue to explore blockchain applications, tokenization of real-world assets, and the integration of digital currencies into traditional finance. While short-term sentiment may be negative, the long-term trajectory of adoption appears intact. This is further supported by ongoing investments in infrastructure, security, and education across the sector. For those on the sidelines wondering whether now is the time to buy the dip or wait for further clarity, there is no one-size-fits-all answer. Investing in crypto is as much about managing psychology as it is about analyzing charts or reading headlines. The ability to remain calm in the face of volatility, to learn from mistakes, and to adapt to new information is what separates